Harsha Upadhyaya, who's the CIO Equities at Kotak AMC, also joins in to add his perspective on what he's feeling about the markets at these levels. Harsha, great to have you on the show. Thanks very much for talking to us. After this near 5% move from in the month of July, from the kind of impact the market witnessed during Brexit, do you think that we are in a firm uptrend? The market is, of course, latching on to two bits of positive news which are likely to come by, which is one is, of course, the GST passage, and the second is under the new regime, more rate cuts from the RBI.
Yes, I think clearly markets have shown quite a bit of resilience in the past month and a half, despite some negatives, and that momentum is continuing even in the month of July. We believe that the global liquidity, which has been so strong, will continue going forward, and along with the liquidity push, you also have fundamentals on the mend. For example, there is a hope that this earnings season is going to be better than the previous one, and hence the earnings growth momentum will continue to pick up. Secondly, we are halfway through the monsoon season, and that seems to be well distributed and as per expectations, and hence the rural economy should also get a decent push. On top of that, today we have heard that GST passage and consideration and passage of the bill has been tabled for August 2nd. So there is every likelihood that it's going to get passed. If that is going to happen, I think investors will look at it as a very good positive as well. So overall, you have fundamentals which are showing turnaround, you have policy push, and also the liquidity has been very, very strong. And given all this, markets have actually done pretty well over the last 2 months, I would say. At this level, we are a bit cautious, not that we are negative on the markets, but I think at least for the short term, there seems to be some sort of a upside gap in the market as per our view. While disciplined and staggered investments will still make you money, but I think immediate money-making opportunities are going to be less frequent from here on.
If you're saying that the upside is capped or it's tricky to make money right now, then what's your view on the earnings cycle? Because a key trigger for returns is really led by how earnings are panning out, underlying earnings that is. And so far into Q1, it doesn't seem like it's a very positive start to FY17. What do you expect or hope for the rest of the year?
I think it's still a work in progress. I would say that some of the companies have shown a bit of turnaround, bit of improvement in profitability as well as top line growth, whereas there is another basket which has not been so strong. I think for mutual fund investors, it would be appropriate to look at funds which are really positioned well for this kind of a patchy earnings growth scenario. What we have been doing in our portfolios, we are looking at companies which are slightly ahead of market in terms of expected earnings growth, and also which are available at reasonable valuations. So at a portfolio level, we would be somewhere in and around Nifty valuations, whereas our expected growth rate for the portfolio stocks would be slightly higher than Nifty earnings expected growth rate. And we believe that this sort of a positioning will definitely help given the scarcity of earnings in the overall corporate scenario. In terms of the focus, clearly we are betting on domestic companies rather than global or export oriented companies, because the global growth continues to remain very, very sluggish, whereas at least there is some growth, even if you call it patchy growth, there is some growth in the domestic scenario, and we are betting on some of those pockets.
Harsha, what about PSU banks? I mean, I think the commentary from two banks that we spoke to, Canara Bank as well as Union Bank on our BSE day, was very positive with regards to upgradations and recoveries. Two, if indeed the bond rally continues, Nilesh was optimistic in the morning as well that things don't look so bad even on that front, then there should be treasury gains for these stocks in the current quarter too. What do you do with the PSU banking space now?
Currently, we are more or less in line with benchmark weightage for PSU banks. I think that positioning will continue for some more time. We do not see resolution to some of the long-standing issues in the sector, which all of us are aware of. While treasury gains will prop up profitability in the very short term, maybe for 1 or 2 quarters, unless and until there is a permanent resolution to the NPA issue, I think some of these banks will continue to underperform, especially in a scenario where the corporate credit growth has come to almost a standstill, and we don't see private sector capex picking up in the next 1.5 to 2 years. So it's going to be more of working capital loans rather than project financing. At the same time, you have very strong retail credit growth which is happening, and which will also get further boost going forward, which means in areas where public sector banks are today very, very strong, those areas are seeing hardly any growth, whereas the retail segment is seeing very strong growth, which means the incremental market share gains for private sector banks which are focused on retail business will continue to happen. So which is a big worry for us if we have to take a higher position in public sector banks, I would say.
Okay, final question from my end, Harsha. What is that you are cautious on the markets, however, earnings would move specific pockets. What is that one basket that you are still extremely bullish on, extremely maybe relatively, extremely maybe absolutely, as the case may be? What is that one basket that you're extremely bullish
on? Clearly, we have been very, very positive on revival in infrastructure spend, and hence that's going to help some of the allied sectors. In this regard, we continue to believe that cement sector will have very good demand coming from both increase in infrastructure spend as well as revival in rural economy. At the same time, we are not seeing incremental capacity additions in the industry, which means that the pricing power is going to be very, very strong. At the same time, we have lower cost pressures for the industry as a whole. So all these augur well for the improved profitability trend, which is already witnessed in the cement sector, to continue for quite a bit of more time. And that's what we are betting on. So I would say the single biggest overweight in our fund house today would be cement sector.
Also IT. I know you spoke about how exporters are a theme that you are still considering and see potential there. But the numbers this quarter around raised quite a few question marks. I know you won't talk stock specific, but Infosys is a core holding in both your Kotak Opportunities Fund as well as Kotak Select Focus Fund. Have you had a rethink after these numbers, or do you think you're in the camp that believes that look, there will be blips, there will be question marks, but the underlying faith needs to be kept with the management, so things are okay?
In fact, even before the earnings season started, we were clearly underweight on the IT sector, and that positioning still continues. And the kind of results that we have seen in this earnings season, it only reaffirms the view that we had about the entire sector. So we will continue that the global business strength is missing, and hence IT will continue to suffer going forward. Relatively, as I said earlier, we would bet on more of domestic oriented stocks in the portfolio rather than IT or pharma. And we believe that IT underperformance will help us outperform relatively on a benchmark, because we have underweight stance on IT.
Right. Then why is it that Infosys is your core holding? Do you think that one stands out against the bunch?
While you would see in the top of the list, it's an underweight position relative to the benchmark. So even before the earnings were announced, we were underweight on the stock. So that positioning still continues.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.